Are you still hodling in 2026? Be honest. Are you holding coins you bought years ago, hoping, waiting, telling yourself it'll come back? Because if you are, you might not be patient, you might be stuck, and that difference could be costing you more than any crash ever could. Let's talk about it. This isn't about selling everything. It's not about day trading. It's about something deeper. Because hodling made people rich in early crypto, but in 2026, blind hodling is quietly destroying portfolios, not through crashes, but through opportunity cost. Let's break it down. Point 1. Hodling worked because the market was young. It doesn't work the same way now. In 2013, 2017, even 2020, almost everything went up. Liquidity was expanding, narratives were fresh, retail was flooding in, so the strategy was simple: buy, hold, wait. But crypto has matured. Money doesn't flow everywhere anymore. It rotates between narratives, between chains, between sectors. AI, real-world assets, layer 2s, institutional infrastructure. And while capital rotates, most portfolios don't. People are still holding old DeFi tokens, old layer 1s, old narratives that peaked years ago, not because they believe in them, but because selling feels like admitting defeat. That's loss aversion. Your brain hates realizing losses more than it loves realizing gains. So instead of asking, "Is this the best use of my capital now?" people ask, "What if it comes back?" And that question keeps them stuck. Most coins never return to all-time highs. Not in crypto, not in stocks, not anywhere. Markets don't care about memories. They care about momentum, adoption, usage, and narrative alignment. If your coin doesn't have those, hodling isn't patience, it's inertia. Point 2. You're not just losing money, you're losing time. Time is the most expensive thing in investing. Every year your capital sits in a stagnant asset, you miss entire cycles. You miss compounding, you miss momentum, you miss opportunity. You tell yourself, "I'll sell when it gets back to my entry." But what if it never does? And even if it does, what if it takes 7 years? What if in those 7 years, Bitcoin does a 4x, Ethereum does a 6x, and emerging sectors do 10x? What did you really lose? Not money, time. And time is the only thing you can't get back. The market doesn't reward loyalty, it rewards relevance. Point 3. Hodling without a thesis is not investing, it's gambling. Real conviction isn't "I'll hold this forever." Real conviction is this asset will outperform alternatives over a specific time horizon for specific reasons. If you can't clearly explain why this coin will outperform Bitcoin, why it will outperform Ethereum, why it will outperform holding cash or yield, then you're not investing, you're hoping. Hope is not a strategy. Here's a simple rule. If you wouldn't buy more of this asset today, you probably shouldn't still hold it. Holding and buying are the same decision. They're just separated by time. Point 4. Crypto isn't about being early anymore. It's about being aligned. In the early days, the game was get in early, get out late. Now the game is align with structural trends. Not hype, not memes, not noise. Structural trends. Institutional adoption, tokenization of real-world assets, on-chain finance, settlement infrastructure, regulatory-aligned platforms. This is where real money flows, not in random altcoins waiting for retail pumps. Institutions don't ask, "Will this 10x?" They ask, "Will this integrate with global finance? Will this scale? Will this comply? Will this reduce friction?" If your coin doesn't fit into that future, it's part of the past. Point 5. The real risk in 2026 isn't volatility, it's stagnation. Volatility creates opportunity, stagnation creates decay. Volatility lets you reposition, stagnation silently bleeds your portfolio through inflation, opportunity cost, and irrelevance. Most people fear selling too early, but the bigger risk is selling too late. Not because you miss gains, but because you miss better opportunities. Markets reward adaptation, not attachment. Point 6. HODLing was a strategy, now it's a bias. HODLing worked, but it became identity. People stopped saying, I hold this because, and started saying, I'm a hodler. That's dangerous. When a strategy becomes your identity, you stop questioning it, you stop adapting, and markets punish stagnation. The smartest investors aren't loyal to coins, they're loyal to outcomes. They ask, where is capital flowing? Where is usage growing? Where is infrastructure being built? And they position accordingly, not emotionally, strategically. Point 7. Most people confuse patience with passivity. Patience is intentional, passivity is neglect. Patience says, I have a thesis, I monitor it, I adapt if needed. Passivity says, I bought this, I'll check it in 5 years. Not making a decision is still a decision. It's letting the market decide for you, and the market is ruthless. Point 8. The biggest shift in crypto isn't technological, it's psychological. Crypto started as rebellion. Now it's becoming infrastructure, from ideology to utility, from speculation to settlement, from retail to institutional. And when markets mature, strategies must mature too. Blind hodling is a childhood strategy. Positioning is an adult strategy. Point 9. Flexible capital survives, stubborn capital dies. The most powerful trait in investing isn't intelligence, it's flexibility, the ability to change your mind, the ability to reallocate without ego, the ability to adapt when the environment changes. Markets are dynamic, rigid systems break, flexible systems endure. Your portfolio should behave like water, not concrete. So what does this mean for you? It doesn't mean sell everything, it doesn't mean trade every day. It means stop holding assets without a thesis, stop clinging to entry prices, stop identifying as a hodler, start identifying as an allocator. Here's a simple checklist. Before you hold any coin, ask, is usage growing or shrinking? Is revenue increasing or fading? Is developer activity rising or declining? Is institutional interest growing or absent? Is this narrative expanding or dying? Is this token essential or optional? Would I buy this today at this price? Does this outperform Bitcoin and Ethereum? Does this align with where crypto is going? Am I holding this because of logic or emotion? If you can't answer these clearly, you're not holding, you're hoping. Let's address the biggest fear. What if I sell and it pumps? That fear traps more people than any crash. But investing isn't about catching every pump. It's about building a system that works over time. Not one trade, not one coin, a system. Over time, systems beat emotions. Here's the truth. Most people who got rich in crypto didn't do it by hodling random altcoins forever. They did it by buying high-quality assets, taking profits, reallocating, compounding, managing risk, and adapting. They didn't marry their bags, they married their goals. Let's talk about Bitcoin. Bitcoin is a strategic reserve asset. It's digital gold, a hedge, a store of value, monetary infrastructure. Ethereum is settlement infrastructure, programmable money, global computation, financial plumbing. Holding these makes sense under a long-term thesis. Most altcoins are not infrastructure, they're applications. Applications are replaceable. Infrastructure is not. Treating applications like reserves is a category error. Let's talk about narratives. Every cycle has them. 2017, ICOs. 2020, DeFi. 2021, NFTs. 2023, scaling. 2024, AI plus crypto. 2025 to 2026, tokenization, institutional rails, programmable compliance. If your portfolio still looks like 2021, you're fighting the market, not flowing with it. Here's a simple framework. 1. Core assets, long-term infrastructure holds. 2. Growth assets, narrative-driven positions. 3. Experimental assets, high-risk, high-reward plays. 4. Exit rules, thesis-based, not emotional. 5. Regular reviews, strategic, not emotional. This is how professionals manage capital, not by holding forever, but by positioning intelligently. Selling hurts. It feels like admitting defeat, but selling a losing position because you're afraid to sell is failure. Selling is a decision. Holding is also a decision. One is active, the other is passive. Markets reward active decisions. At the end of the day, your portfolio is not a museum. It's a tool to build freedom, a tool to protect your future, a tool to create opportunity. Use it, don't worship it. Here's the takeaway. HODLing is not a strategy in 2026. It's a bias, and biases are expensive. The market rewards positioning, not attachment. It rewards relevance, not nostalgia. It rewards adaptation, not rigidity. If you're still HODLing in 2026, you might be doing it wrong. But the good news is, you can change that today. Not by trading, not by gambling, not by chasing pumps, but by thinking differently, by allocating differently, by acting differently. If this made you rethink how you approach crypto, if it challenged your assumptions, if it made you uncomfortable in a useful way, then it did its job. Subscribe for more content like this. Not hype, not noise, just real conversations about how crypto and money actually work. And remember, the goal isn't to be right, the goal is to be free. And freedom comes from clarity, strategy, and adaptation, not blind HODLing.